From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
First things first, I want to congratulate you on a great decision. This is the best investment that you possibly could have made, the investment in yourself.
And whether you're a seasoned trader or a green novice beginner, you must learn one thing, and that is you got to learn before you can earn. Now, you're going to, in this class, learn how the pros learned. The reason is not because we want to make you a professional floor trader standing on the floor of an exchange, but because only you truly care about your money. And since you're going to be trading your money, not some firms, you need to make sure that you have the best knowledge possible. You should demand to have the absolute best knowledge you can get.
Yeah, the way that we designed this course basically is to fill the needs of both the early beginners all the way over to the seasoned option traders who want to squeeze every single penny possible out of their options positions. So that's why we created Options GPS. One was for gaining an edge over almost every other investor out there in the world, including professional traders. Second was to learn what your broker won't tell you, or frankly might not even know. And three, recover some of that lost money. Protect your current account from losing any more money, and of course the fun part, which is making even more money.
Now here's an outline of our course, a little journey you're going to take with us. This course is broken down into 4 sections. First, options basics. Then we're going to move to option theory. Third, basic strategies. And finally, fourth, advanced strategies. Chris is going to start off by taking you through options basics.
You're going to get a bird's eye view of how the options markets work. You're going to learn a few different secrets on how to get the better price on your option trades that about 99% of all option traders don't even know about.
Now, you're going to start off by learning the fundamentals of calls and puts. And you're going to learn how to make money not only in up markets, like Wall Street seems to do well, but also in down markets and in flat markets.
So once you've got a solid understanding of how the options markets work, we're going to give you the building blocks that a lot of the other educators completely miss out on, and that's options theory.
Other educational programs quite often save the most fundamental and foundational concepts until the end. But that's not right. You've got to start at the beginning, and you have to build the foundation right up front from the get-go. Building this foundation nice and strong is going to allow you to then build your entire option theory from there all the way up to the sky.
We're also going to introduce you to the Greeks. And I'm not talking about the ones that you met in literature classes. You're going to take the Greeks that are related to the options market, and you're going to combine your newfound knowledge of option pricing and the Greeks, and you're going to apply that to synthetic positions. I don't want you to be intimidated by all these terms I'm throwing at you, the Greeks and synthetic positions. We're going to make it really easy for you.
Moving along from there, we're going to go right through basic strategies, including the stock replacement strategy, covered calls, protected puts, and many more.
Then after that, what we're going to do is we're going to get into the more advanced strategies. Advanced strategies like diagonal call spreads, straddles, butterflies, and a whole lot more.
Now you're going to learn how to make money, whether the stocks are going up, down, or sideways. You're also going to see how to take a losing trade and in one fell swoop, one little addition, one little change, spin that into a trade that starts making you money. In addition, you're going to learn 14 of the greatest profit strategies in this course. From there, in addition, you're going to get Chris going through some of his secrets of technical analysis to help you identify the opportunities and really get accurate with the timing of when to use these strategies.
Plus, you're going to have access to our 24/7 members-only website, and that houses an active community full of your peers who are all learning the same material that you are. You're going to have a number of course materials and a glossary to supplement your education, and you received access to the website when you signed up, so don't miss out on this great chance to enhance your options education by using that website. So to get the most out of this course, I want you to watch the DVDs in order. I know it's tempting to skip ahead and look at the strategies that are out there, but without that solid foundation, you're going to be taking unnecessary risk, and you'll probably end up realizing unnecessary losses.
Now, during our careers in trading, Chris and I have probably made just about every single possible mistake that you'll ever be able to make. What we want you to do is to learn from our mistakes. You don't need to make these mistakes on your own. They will be very costly. So learn from our mistakes.
Right, please, just be patient with yourself. This is a course, it's less than 30 hours. If you devoted 1 hour a day, in a month, you'd be able to move ahead with the knowledge and the confidence that most professional traders don't even have.
You will best benefit from the course by mastering each individual section before moving on to the next section. In fact, you may find it more useful to review sections as you go along instead of going straight through the course.
So be sure to complete the course before you decide to start applying these strategies. Please, we're talking about real money here. So you may even want to check out the various paper trading services that are out there before you put that real money to work for you.
So now all you have to do is sit back, relax, and enjoy the ride along the road to success with Options GPS.
Now let's get started with Options Basics. Let's start off with the basics of options. First, what's an option? Well, an option is an exchange-tradable derivative product. Now, I know I've already started intimidating people with the language. Don't sweat it. Let's just break that down for a second. When I say that, all I mean is that we're trading an option that's on an options exchange. That's what I mean when I say exchange-tradable derivative product. When something trades on an exchange, it just means that you can trade it just as easily as you could buy or sell a stock. It would be a lot harder, if you think about it, to buy or to sell a 50% ownership in a small neighborhood restaurant, for example. So, I mean, I could take a month or more with all the paperwork and the attorneys and everything like that. But if you wanted to sell your 500 share ownership in Starbucks or something, you'd be able to sell it right away, 2 seconds, because it's an exchange-tradable security. So that's what I'm talking about here. Just like buying or selling parts of companies can be done in a lot of different ways, the same thing goes for stock options. We're only going to be focusing on the simple ones, the exchange-tradable ones. We're not going to talk about over-the-counter options or behind-the-scenes options or exotic options. We're talking about exchange-traded options, something that you can see. Now, options are a derivative product, and one of the things that I want to talk about is dispelling some of the rumor and some of the innuendo that we have about that terrible derivative word. Derivatives only mean that the price of the security, the option, is based upon or is derived from the price of something else. In the case that we talk about most often, it's options on stocks. And that means that the option is getting its price derived from the stock price. The price of the option moves up and down because the underlying instrument moves up and down. Now, there are options on other things. There are options on stock, but there are also options on ETFs, options on currencies, indexes. There's options on commodities, even bonds. There are options on just about anything that's tradable, but we have to understand that the word derivative simply means derived from. Now, one of the derivatives that I love the most is one of my favorites, ice cream. Now, ice cream's a derivative. Why would you be afraid of ice cream? Is it just because it's a derivative? Now, it's a derivative simply because it's derived from milk. Now, what would happen to the price of ice cream if the main ingredient, milk, went up by 500%? That would impact the price of ice cream, wouldn't it? So that's all that we're saying. When we say that options are a derivative, when the price of a stock or an ETF fluctuates, the options prices are going to change too. So when you hear the term derivative, don't be afraid. The other thing that we have to know is that an option is actually a contract. It's a contract that's written between two parties, a buyer and a seller. And each of these contracts, or stock options, represents 100 shares apiece. In other words, an option contract is typically a contract between two parties that address the purchase or the sale of 100 shares of stock. So 2 option contracts refers to 200 shares of stock, 3 options is going to refer to 300 shares of stock, and so on and so on. Now let's talk a little bit about the mechanics of the market itself, because believe it or not, the options market is very similar in its operations to the stock market. First, let's talk about the exchange. What's an exchange? Basically, an exchange is where buyers and sellers meet to conduct business. The hours of operation are from 9:30 to 4 o'clock for the equity options and until 4:15 for index options. And if you don't know what that means yet, then don't worry about it. Just like the stock market, the options market is open from Monday to Friday. There are several different exchanges like the Chicago Board Options Exchange, the Philadelphia, the Amex, the NASDAQ, ISC, several others. Okay, so the exchanges are almost like a shopping mall. You go to a shopping mall, it's one big mall, and has a whole bunch of different stores. Think of each of the different stocks that are trading on the exchange as its own little shop in the big shopping mall. That's kind of like what's going on in the options exchange. And you have a lot of different role players there, and you need to know who's there, and you need to know what they do. It's going to help you get a better price. Each exchange has its own in-house regulatory body, so you can feel comfortable trading there. Basically, they handle problems, and if there's any problems that are too big, they forward it to the SEC. They're kind of like the cops. Market watch and market surveillance, they're the internal regulatory system. They just make sure nobody's being bad. So they're like the cops, and the SEC is like the FBI. Okay, so we talked about the guys that make the system fair and who regulate it. But let's get into the exciting stuff. Let's start talking about the players who make the market work. Now, first, let's keep in mind that today, when technology reigns supreme, a lot of the people that used to be involved in making your options trade actually happen are eliminated. Today, especially with the help of all the online brokerage firms that you see, you actually key in your order on your trading platform that you have right on your computer. And these days, you bypass all the people that you used to have to go through and that you used to have to use to get to the market makers. But I'll briefly run through the old school steps here. And they're still in use today, but just much less so. I mean, over the years, when I used to visit all the different exchanges, you'd notice all the crowds. They've thinned out dramatically. And there's not as many people there as there used to be because lots of them are trading electronically from the beach. But a lot of business is still conducted on the floor of the exchanges. So I'm going to paint the picture for you, and you'll know how we got to where we are today. Now, on the exchange floor itself, you basically have three players that are all different types of floor traders. You've got your specialist, only one specialist. You've got market makers. You've got a whole bunch of market makers, hundreds, sometimes more. These are the people that are considered exchange floor traders. Now, market makers and the specialists are actually traders that are trading their own account, doing what they see fit as they want to do it. The floor broker is just a guy who actually he's executing the customer orders. So when you tell your brokerage firm to buy something for you, then your firm might call down the order to the floor, and they're going to give it to the floor broker to handle. And the floor broker brings the order to the crowd of market makers and the specialists. So for each security, there are lots of floor brokers, there are lots of market makers, but there's only one specialist. As a matter of fact, Ron Ianieri, who I invited into this course to teach options theory and strategies, was a specialist, the specialist, for Dell Computer Options in the 90s. And that was the most active stock in the mid-90s. So what that means is that Ron was a market maker, the market maker, in the crowd of market makers, and he was the guy controlling the entire crowd, or else it would be mayhem. Now, there's also some other staff on the floor. They're basically the helpers that help the floor traders. There's all sorts of different clerks. We have specialist clerks. Basically, the specialist clerk is there to help out the specialist. So he's assisting the top dog, so to speak. And who did we say the specialist was? Again, like Ron, the specialist is at the top of the food chain on the options trading floor. He has the most responsibility, he takes the most risk, and therefore he has the most privileges. So the specialist is a market maker in a particular crowd that's assigned some extra duties, kind of like a market maker on steroids, if you will. So he's responsible to make sure that your order is posted and your order is seen and that your order is fairly represented in the crowd when it trades at your limit price. So he's got a lot of extra duties, and a specialist clerk is there to assist him. Now, there's also a phone clerk, and that phone clerk would take the phone call from your broker and jot it down and so forth. And then there's also a data entry clerk who actually types in the actual trades as they occur to make sure that both parties are properly represented. Finally, you've got a stock execution clerk. Now, the stock execution clerk executes stock orders. The traders on the options floor, they're trading options, and they hedge themselves against these option positions, and they normally hedge themselves using the underlying stock or the underlying ETF, and that's where the stock execution clerk comes in. In order for them to do that, the stock execution clerk is nearby, sitting next to them, and he's going to execute all the stock orders for the option traders so they can hedge their positions properly. So it used to be that the only way to get the trade done was for the customer to call the broker, and then the broker calls the floor post, talks to the phone clerk, who got to the floor broker. That floor broker goes into the crowd, which is all the market makers, and then including the specialist. And then the floor broker would get to the market makers, having to work with the data clerk and the specialist who ran the show, and he needed the specialist clerk. Then they have to do the same exact process to get the price back, You get the report to the customer, and to the broker, and then to the customer. And you keep in mind, when you enter your order today, you enter the trade on your computer. It bypasses all the middlemen. It goes right to the specialist and the market makers in the trading pit on the floor of the exchange. And even when you call your broker with a telephone order, chances are your broker's probably entering the order on their computer, and it just bypasses all the middlemen, goes straight to the specialist. So when you have an institution, which is a hedge fund or a mutual fund, when you have an institution with a huge order, they're going to go through this whole process because they want to feel out the market using all the human beings. So the bigger institutions are the mutual funds and the hedge funds. Now, mutual funds can't use options at this current time. However, the SEC, the Securities Exchange Commission, they're the guys that govern, and they're the governing body of all the trading in the U.S. The SEC has been changing some of the rules. They've been making it a lot easier for more and more individuals and institutions to use options for hedging purposes. So I'd be shocked in this day and age, especially after the kind of historic markets that we recently saw, if we don't see mutual funds soon able to use options. Hedge funds use options. Well, at least they're supposed to be using options. They're supposed to hedge. They don't always do that, unfortunately. They don't use options all the time, but they're legally allowed to. And there's some very large hedge funds out there that are in the options market on a regular basis. Now, that's all good and fine, and now you understand the different people out there and what they do, what their jobs are and everything, but now you need to know what happens to your trade. So how does your trade work? What's the pathway of putting in your order and getting some kind of execution back? Now, as I explained, everyone used to call their broker up on the telephone, and they used to have to go through all these middlemen that you see here on your screen just to get the stock or the options order executed. But today, especially with the help of these online brokerage firms, you bypass all that, so you don't have to call your broker, he doesn't have to call the floor doesn't have to send a runner anywhere. The order goes straight to the crowd at the specialist post. Now, the specialist is who? He's the market maker on steroids. He's the top dog. So he's where the buck stops, so to speak. And since he's the market maker in the crowd, he has extra duties, and one of them is to properly display and execute and represent all public orders that are in his crowd. So your order has to go through that crowd of market makers that you see here, one of which runs the show, and that guy's the specialist. The order actually goes electronically directly to the specialist with all your retail information already there, your account number and everything like that. And just about everything is handled electronically. Soon, everything is going to be handled electronically. Now, you've got rules to protect the individual investor, so it's great for you. Now, the individual investor rules are as follows. You've got a rule called customer priority. That just means that the customer's order trades first. You get priority. The next rule is that the highest bid and the lowest offer must be shown to the world. You've got another rule called trade or support. That just means that the order must be shown immediately, like we just said, and if not, that order must be traded. Then you've got market maker obligations. Now, they must make a compliant two-sided market, so let's talk about them for a minute here. Let's first cover the rule customer priority. Now, as a retail customer, you're given the status called customer priority, and that means that if your order is at the same price as what the market makers in the crowd have, you must come first. Your trade must come first. Retail orders come first at the given price. Now, there's a small exception to the rule, and that is when the market maker is closing his or her position out. I'm not going to get too deep into the mechanics of how that works because I don't want to confuse you at all. But just so you know, in most cases, the customer's order has the priority over the market makers. And even when the exception does come into play and the customer doesn't have priority, they're going to have equal share or the same exact priority as the market makers have. So let's say that the bid is $4 and the asking price or the offer is $4.30, and you decide to bid $4 for the option. Let's also say that at the same time, you've got a bunch of market makers out there in the crowd, and they're bidding $4 for the option too. So what would happen if a seller came in and wanted to sell at $4 per option? Well, if you're bidding $4, you would get priority, and your bid is the one that the seller is going to sell to. Now, obviously, if someone's bidding higher than you, like a market maker or anybody else, then their price is going to be the one that gets executed. They're going to get executed on their price. They bid higher than you. You're not entitled to that higher price, obviously. So they're the one that's going to get done. However, if an order is executed at your price, then you're going to be the one that comes first. The customer always comes first on the options floor. If a seller comes in and sells at the bid, the customer gets the trade. Now, if there are a bunch of market makers and 2 customers, then the trade's going to be divided between the 2 customers. You can see here what happens. The seller comes in, the customer's at 410, 2 market makers. Seller sells at the market, customer is the order that's going to get filled. The next rule, displaying the best bid and the best offer. If your order isn't executed, it has got to be displayed. What I mean by that is you see a market on your platform, just like the stock market, for example. Here, I'll show you what I'm talking about. You've got IBM stock here. IBM's bid at 100, and you can see that it's offered at 101. That's the bid and offer. That's the market. Now, that's supposedly the best bid and the very best offer that you see. Now, in the options market, it works the same exact way. The best bid and the best offer are posted. If you happen to be the best bid or the best offer, your order should be displayed, thus disseminated around the world so everybody in the world can see your best bid. Now, in this example, you can see all the offers and all the bids. But in real life, you're not going to be able to see all the higher offers or the lower bids like you do right here. This is what's really going on in real life. In real life, there are bunches of bids out there, all leading up to the very highest bid. Bunches of offers out here. The lowest offer is the one that they're going to show. So all you're going to see are these 2 numbers right here. Let's take a look at Apple stock. You can see that only the highest bid is shown and only the lowest offer is shown. Let's look at another example here. And this is what you don't see that's behind all the bids and all the offers. Hidden are even lower bids than the bids that you see. Typically, you only see the highest bid, $46.25. Same thing on the other side. Typically, you only see the lowest offer. But hidden behind that, there are tons of bids that are lower and tons of offers that are even higher. In the options market, it works exactly the same way. If you happen to be the best bid or if you happen to be the best offer, then your price should be shown and disseminated around the world so everybody on earth can see it. You can see an option here trading at $7.85, which is the highest bid, and you can see that the lowest offer, which is shown, is $8. That's what it's going to look like on your screen in real life. The next rule we said was highest bid, lowest offer must be shown. If it's not shown, the market makers have to trade you. They have to trade your options order or they have to show it. You can see here the bid and the ask. Let's take a look at another slide. The bid here is 410 and the ask is 430. Now you've got a couple of market makers bidding 410 and that's the bid that we see. But let's say that you come in and you bid higher, so you decide to bid 420 right in the middle. It's now the best bid. It's the best bid that's shown. So you have the 410 market makers here at 410. You come in at 420. All of a sudden, that's going to change to 420 because it's now the best bid. That means the order must be shown immediately, like we just said. And if not, it must be traded. So if you sit on your computer, you enter an order at 420, and you don't see that order pop up, then your order must be traded by the market makers. And then it'll turn right back to 410. Or it'll never turn to 420, it'll just stay at 410, and your order will be done. So if you're the buyer and you're bidding on the option contract, you'll know that if your trade doesn't get executed, if it doesn't get done, and you have the best bid or the highest bid, then you know your bid's going to be posted immediately. And if you don't see your bid, it should have been traded. Now, what about when you are the seller? You see, right now, we have the market at 410 and 430 again. You got a couple of market makers bidding 410. The asking price is 430 right there. The same exact rule applies. So say you offer the option at $4.25. If you're the seller, you're going to know that if your trade doesn't get executed and you have the very best offer out there or the lowest offer, then you know that your trade should be posted immediately. Now, just as a side note, market makers, the crowd, the market itself, they have a responsibility to either show your order or trade it, as we said. And we're going to use that a little bit later, and we're going to show you how you can use that to your advantage. Sometimes you can get better pricing in the options market, and you can trade between the bid and the offer, with that rule in mind. So you're going to be able to take advantage of the market maker's rules. Now, the market makers have obligations and they have duties. I know everybody thinks that the market makers are these evil, dirty rat bastards of the industry. But to be honest, they're really not. Normally, they're the last person that's going to know the news. And so normally, they're the ones that are paying the price. They're not sitting there looking at their BlackBerry, what the news is. They're finding out when the order comes to the market. So the fact is, the market makers, they're obligated by rules. They must make a compliant, two-sided market. Now, what do I mean by compliant? When we talk about a market maker making markets, first off, he can only be so wide in his bid-ask spread. That way, you're guaranteed a reasonably tight market. So in other words, the spread can't be too big. There can't be too big of a difference between the bid and the asking price. He also has to be a certain size up, meaning that both his bid and his offer must be good for a specific amount of shares or of contracts, in this case, in the options market. You can see this on the OCC website. You can go to the OCC website and you take a look at the rules stating the maximum width that a market maker is allowed to make for any given options price. And you can also find out how big they must be in terms of the size of their bid and their size of their offer by rule. So they're actually there to provide liquidity. That's their job. And this way, you're always going to be able to enter or exit your options positions, and you're not going to have to worry about getting stuck with an option that you want to sell or not being able to buy an option that you want to buy. Now, let's talk about the different vending services out there, because we want to talk about more than just the mechanics of options and how they work. We want to pause here for a second, and we want to talk about the tools that you can use to profit from options, because that's why we're here, to profit. Let's talk about vending services for a minute. Now, what do I mean when I say vending services? I mean companies that are out there, and they're going to be providing you with a service and lots of information and things like that to help you hopefully become a much better trader. So there are online brokerage firms that are out there. Nowadays, the big brokerage houses are not the ones that are really the major players in the options market anymore. Why? It's easy. Cost. Online brokers give you the analytic tools that you need to make these trading decisions most of the time. They give you research. They give you anything that you need at a much cheaper price than the big brokers will. And they also have the ability to handle your order electronically. So you don't have to worry about your broker who has this big institutional account. You don't have to worry about the broker worrying about another bigger customer while your order just sits on his desk and doesn't get out to the market in time. Online brokerage firms allow you to put your order in directly, electronically, so you can guarantee the timeliness and the speed of your order to the market. So if you're not using an online brokerage firm, I highly recommend starting. I happen to recommend if you generally call your orders in, you have to understand that order is probably going to get in a little bit slower than the online brokerage will allow your order to get in. Now, research firms, we've got a lot of different research firms out there, and they provide research like fundamental analysis. Now, some firms are great when it comes to their research, but you have to understand a couple of things about research firms. You can trust research from analysts pretty much just as much as you can trust politicians. Many of them out there, and they're trying to do the right thing. But never just take their word for what they're saying, just like politicians. Frankly, even when they're honest, there's an old saying on Wall Street, 50 different analysts will give you 60 different opinions. So it's hard to take anyone at their word these days. And a fundamental analyst will typically think that they're right, while everybody else out there is wrong. So I like to do my own fundamental research, but you may not have the time or the ability to do that, and that's where technical analysis comes in. When you use technical analysis, you'll always know that you aren't being lied to. So it's about supply and it's about demand, not what the CEO says about a balance sheet or the CFO says about their accounting. It's not about what the analyst says about the stock or the sector and their opinion. There's an old saying on Wall Street, the tape never lies. That means price never lies. If a major brokerage firm owns an analyst service that you're working with, you better make sure that you scrutinize that data that you're going to get from them. But now let's talk about the analytic tools and the analytic services that you have out there. There are charting services and there are risk management services. Everybody's talking about risk management these days. And there are trading services out there that you can use. You have charting services. Charting services will help you narrow down which situations have the highest probability of being successful. They'll help you time your positions, so time when you want to enter or exit your trades. And those who know me know that I'm a big proponent of technical analysis. So you may or may not know how to use technical analysis yet, but you can always take my technical analysis course called the Internal Strength System. It's a system that I use to figure out which direction the market's about to move in and decide what trades I make. So if you want to learn more, you can go to tycoonreport.com or tycoonu.com and check that out. But what I'm saying here is that you can use analytic tools and risk management services, charting services, or data services. There are a lot of them out there. One of the most important data services you could check out is Sector Hunter. So what Sector Hunter is, it's an algorithm, basically tells you when institutional money just started to pour into a sector or started leaving a sector. So, 80% of a stock's move has to do with the sector that it's in, like oil or oil service specifically, or the Wall Street sector or banks. And Sector Hunter just analyzes over 40 broad sectors for you, and you can decide from there what you want to do with the data. I also mentioned trading services, and there are a lot of trading services out there. There are many different styles of trading services and investing services, but check out a few of them and feel them out. Find out which one works best for you. Find out which one you're most comfortable with. A lot of you out there don't have the time. I mean, you're working, you've got a job, maybe you're working 8+ hours a day. You don't have time to do all the research, and you don't have time that you might need or want to knuckle down and do all the research that you want to do. So you look for a trading service out there. So the TrendRider, for example, is my options trading service. I give trade recommendations, market commentary, and monthly webinars and a whole bunch of other goodies. But there are a lot of independent advisory services or trading services out there. They supply you with trading ideas or investing ideas for the long term. And as long as you do your due diligence, I recommend using any one that you feel comfortable with. One of the most important pieces, though, about the due diligence that you should know is you should try paper trading the service's picks for a while to see how they perform. You want to see if their style matches your style. So again, as long as you do that, you test the waters, you don't test it with real money, so to speak. I don't have a problem with anybody using any service after they've done their proper due diligence. Now we need to talk a little bit more about the bid-ask spread. The bid-ask spread, it's the market makers are out there and they're providing liquidity based upon a bid and an offer or an ask and the size of that bid and offer. The bid price is the price at which the market will buy a specific security. The ask price is the price at which the market is going to sell a particular security. So what you have to realize as a customer, an individual investor, a non-floor trader, is that you're on the wrong side of that equation if you want to get your trade done immediately. You have to go in, you have to buy on the offer, you have to sell on the bid. And that just means that if you take a look at the bid-ask spread, knowing that you have to buy on the offer and sell on the bid if you want to do the trade immediately, you're actually buying at a higher price and immediately selling at a lower price. The market maker can buy on the bid and sell on the offer. That's their business. That's how they get paid. The customer can buy on the offer and sell at the bid price. So when the option is bid $420 and it's offered at $440, that 20-cent difference between the two is known as the bid-ask spread. That bid-ask spread is going to be a loss for you immediately. It's going to be a gain for the market makers. So just remember, the market makers are there to make money. That's why everybody goes to work, right? But they also have responsibilities. And they have to pay for these responsibilities somehow, or they have to be paid for those responsibilities somehow. They're taking a lot of risk out there, supplying you, the customer, with liquidity. So remember, anything that you want to do, the market makers have got to give you a price. Not only do they have to give you a price, but they have to take the other side of the trade, which is often the wrong side of the trade. If everybody and their mother wants to buy something, the last thing I want to do is be the guy who's selling it. But as a market maker, I'm forced by rules to give you a price where I'll sell it to you, and I also have to give you the price where I'll buy it to you. And once I make the arrangement with you, I have to honor that arrangement. So don't beat up too much on the market makers out there. They're not the bad guys. A lot of people think that they are. They're really not. They're just providing you with a service, the ability to get your trade done, get your trade executed, to make the money that you want to make in the options market or in the stock market, for that matter, in your investment accounts. So just remember, the market makers, like you, they're there to make money. They earn their money off of the bid-ask spread, but they're really providing liquidity to you. So let's talk a little bit more about the quotes. Since we're talking about the bid-ask spread, let's talk about the bid and the ask. And before I get into hypotheticals, I think it's really important to take a look at a real-life example here, because you're trading real money. This is what it's going to look like on your screen. This is the options chain on, let's see, Newmont Mining, NEM. That's a gold company. It's besides the point. Now you can see at the top of the chart here, you've got the stock quote, which is 47.04. We're going to call 47 for the sake of simple math. And you can see that for some reason, probably because the snapshot was taken after the market closed, that the bid-ask spread is $1.40. The bid's $46.25. The ask is $47.65, or the offer is $47.65. Below that, you can see the January 40 call right here, and you can see that the bid is $7.85 and the ask is $8. Now that's a 15-cent spread. That 15 cents is what the market makers are trying to capture all the time on the exchange floor. That's why they go to work. They can only capture the 15 cents because what they're doing is they're taking risk and they're providing a guaranteed market. They're providing a guarantee that anyone can sell at $7.85 and anyone can buy at $8. So this is where it gets interesting, and this is where I'm going to show you how you can get a better price than most people understand that they can by trading a smaller number of contracts. Now the bid is 4 and the ask is 430. And below that you see size, 20 and 30. Now let's talk about the bid first. Remember, we said that the bid is the price at which the market is willing to buy something. That means you, as the customer, have to sell at that price if you want to get out immediately. If you feel like selling an option, you're going to have to sell at that bid if you want to get out immediately. That means you're going to be selling at $4 per contract. If you're a buyer of the option, and you want to guarantee that your buy order gets executed right away, you have to buy on the offer, which is the ask, 430. Now, below that, we see the size, 20 by 30. What does that mean? Now, if you remember, I told you that a market maker is obligated by rule to not only supply a bid-ask market, that's the maximum parameter wide, in this case 30 cents right here, but also the size of the market. So not only are they bidding $4, but they also have to tell you how many they're willing to buy at $4. So when you see that size, 20 by 30, that represents the bid and the offer. What that actually means is the size of your bid, meaning that they'll bid $4 for 20 contracts right here. And so when you see the size, think of your bid and your ask. Bid is on the left, the ask is on the right. Same thing works with size. Bid is on the left, ask is on the right. 20 contracts bid for, 30 contracts offered. So if I was going to sell this option at $4, I can sell guaranteed up to 20 contracts. Does that mean I can only sell 20? No, it doesn't mean that. The bid might actually be for more than that. But we do know that is the minimum that I'm allowed to sell on that $4 bid, 20 contracts. Meanwhile, on the ask, where I'm a buyer, if I want to buy right away, I have the ability to buy at least 30 contracts. That's the posted size, 30 contracts. They're willing to sell at $4.30. So do understand, the market makers are held to that size by rule. So they can't sit there and show 30, and then after you go up, you try to buy at 30, they turn around and they say, you know what, I only want to sell 10. The only time that the market maker is allowed to change his quote and his size is in two cases. One, when the movement of the underlying stock, it might fluctuate, and that's going to affect the price of the option. The second is an order that got there before yours. So, for example, if you want to buy these 30 that you see here offered at $4.30, but another customer wanted to buy them also, that customer's order got there first, then they can fill the other customer's order for 30, and then they could say, well, wait a second, the 30 traded ahead. Sometimes that happens. They might press their enter button a split second ahead of the time that you do. So you're going to hear that term every now and then, traded ahead. If 30 traded ahead of you, that might change the offer. So they might move the market up, and you might not be entitled to the 430 that was just posted because the options offered at 430 were just bought by somebody else ahead of you. Now, the market makers are strapped with all these terrible rules. They're just locked down. And, I mean, the rules that the market makers are held to can benefit you if you understand how to use them against the market maker and in your favor. So one of the most important things that as an individual investor that you can take out of this is learning to get a better execution price by trading between the bid and the ask. So let's take a look at the market that you see on your screen right here, 620 by 650. There's a 30-cent spread. Now, assume that you place an order to buy one contract in between the bid and the ask, and your order is to buy at 640. So what's going to happen to the quote? Well, remember what was stated earlier. The best bid must either be traded or shown. So if the market maker doesn't want to show your 640 bid, and they often won't, then they have to trade it to get it out of the way. In other words, they have to fill your order. Again, if they don't want to show your bid, and you're going to find that often the market makers don't want to show your bid, especially if it's for a small number of contracts, then they have to trade it immediately. That's a rule that you can take advantage of to get a better price. If you missed that, I'm going to explain that again in a second, so don't worry about it. So let's talk about what happens now. There's going to be a new quote, new bid-ask spread, 640 by 650. You're going to see the quote actually move. It's going to move from 620 bid, offered at 650, to now 640 bid, offered at 650. That 640 bid is now your bid. If someone comes in to sell, they're going to sell to you at 640. But you see how the spread's tightened to 10 cents, right? Well, the spread's only 10 cents wide, and that's why the market maker may not want to show your 640 bid. They might just trade it immediately. Remember, the market makers make their money off of what? Bid-ask spread. So for them, the optimal bid-ask spread is the widest possible spread. If the rules say that they can be 30 cents wide, they're going to be 30 cents wide. If they're allowed to be 50 cents wide, well, then they're going to be 50 cents wide. Why? Because their money is made at the bid-ask spread. That's what they call on the floor their VIG, V-I-G, VIG. And it's kind of like for all you gambling fanatics out there who know that the bookie, he talks about the VIG. Now, our bid is now the highest bid. It's 640. It must be shown. If they want to sell us our contract at 640, then they'll execute it. We'll get our fill, we'll get our execution, but fill is often what it's called. We're going to get our confirmation from our broker that we bought our contract at 640. Then the market makers can rewind that market out to that 30-cent spread that we saw a moment ago, and that was at 620 bid and offered at 650. So just remember, market makers generally want this spread to be as wide as possible. So if you enter an order between the bid and ask, the market maker might fill you just to get you out of the way. The fact is that if they don't execute you when your bid is now the best bid, they have to post it. So let's just talk about this for one more second, because I want you to understand. They're held, you're going to find in a minute, they're held to a particular guaranteed size. What that means is that, we said earlier, if the size of the market says 20 by 30, that means that they have to buy at 20. Now, the market makers have to make that size. That's part of their job. That's one of their responsibilities. So what happens is, if you go out there and you bid for 3 contracts at 640, the market makers are responsible for representing the other 17. That gets you up to 20 contracts bid at 640. Now, if you bid at 640, what you're doing is you're forcing a market maker to bid higher than they actually want to bid. So somebody can come in and sell them options at 640 when they didn't want to buy it at 640. Only because you went out there, you bid for 3 option contracts, so force them to bid for the other 17, you put them in a bad position. So often, if you bid for a small number of contracts and you go out there, you show a higher bid that's somewhere in between the bid and the ask, they'll sell it to you right away just to get you out of the way, because they don't want the responsibility for buying at a price that they don't want to buy at. So the same works on the offer side. Let's just say now that we have a bid at $860 and the offer is $890, and you decide that you think that the option's way too expensive. Now you want to short it. You want to sell it. And you're willing to sell at $870. Well, again, either the market has to fill your order or they have to post your offer. So let's say that they decide not to fill you, and the offer at the time was $890 with an $860 bid. That's a 30-cent wide spread. So the market makers want a spread to be as wide as they legally can have it in order to make their money. But now your new offer has come in. Your new offer of $870, and it's an offer that's in between theirs, and that closes it up to 10 cents. Now remember, selling at $870 is definitely way more aggressive than selling at $890. So now the better asking price is $870. So what happens here? Now with you coming in and offering $870, basically the spread is only 10 cents wide. You've closed it. Market makers aren't going to like that small spread. But unless they want to trade and they want to basically fill your order at $870, they have to post it. So the reason that this has to be posted is that this is an actual rule that they have to follow. It's called the limit order display rule. Fact of the matter is, when your order hits the market, there's a simple saying, fill it or post it, or fill it or show it. Whatever you want to call it, they either need to execute your order or they have to show it to the world. One or the other, that's the rule. Just know that for future reference. Know that if your order is at $870 and it's not been filled, meaning nobody bought the option that you're trying to sell at the price of $870, it better be posted. So check the quotes in after your order goes in, and if you've not been filled, your $870 offer should be there. If it's not, you should be able to call your broker, tell your broker to either fill it or post it, one or the other. Force them to do something, because you don't want your order just laying around out there, not allowing the world to know that you're willing to buy or sell at a better price than what everybody sees. So fill it or post it. All right, here's another example. In this case, looks like we have a $750 bid and a $780 ask, or $780 offer. Now, what you have to know, and this is a blanket rule that goes across the entire industry, every best bid and best offer has to be good for at least 20 contracts. That's what I mentioned to you just a few minutes ago. Some options you might find are just a little bit more active. So, some market makers, the crowd, they might give you a guarantee of 100 on the bid and 100 on the offer. But we do know that every single bid and offer in every single market, on every single trading floor, is good for at least 20 contracts. That means that if you see a bid for $750, you know that you could sell at least 20 contracts at $750. If you see an ask or an offer at $780, you're going to know that you can buy at least 20 contracts at $780, unless, of course, somebody trades ahead of you right before you're able to execute your order. They might hit the submit button a little bit faster than you, and that's the only exception. Okay, obviously, we're talking about a lot of different rules here, and we levied them upon the poor old little market makers that we could take advantage of now instead of be afraid of. So, to whom do we owe the gratitude? Who do we have to thank for these wonderful rules that favor the customer and make it easier for us to get a better price as long as we understand the rules? Well, obviously, somebody had to make these rules, so where'd the rules come from? You might think that the SEC made these rules. You know what? SEC didn't make these rules. The SEC enforces these rules. But these rules here were made up by the OCC, the Options Clearing Corporation. Now, the OCC, as it's called, is basically a private entity, much like, in a sense, the Federal Reserve is a private entity. A lot of people think that it's a government agency, but it's not. The OCC is not a government agency either. It's a private entity. They're created and owned by all of the options exchanges. So one day, all the options exchanges got together and they said, look, under the heading of the OCC, we're going to go ahead and we're going to make things uniform between all exchanges. So we want to make sure that we have a way of guaranteeing the customer that their option order is going to be executed and treated as they want. And so there's no defaults on either side of the options contracts. Remember, it's a contract. So that you know, because a lot of people worry and they think, well, these option contracts I'm using, well, they're contracts between me and somebody else. So what happens if that somebody else defaults or they go under or something happens? And then they don't actually have to, or maybe they don't have the money to fulfill their obligation. Maybe they go bankrupt or something like that. Well, would I lose my profits? Is my option order gone? What's going to happen? Well, no, none of that's going to happen. The OCC is there. That's one of the main reasons that they were created. Now, let me tell you how the OCC runs and works, because it's actually pretty ingenious. You would think that a contract between two parties would be restrictive on each side. It's a contract. I mean, if you want to do something with your options contract, like exercise that contract, and we'll get into the mechanics of how that all works soon, then you might think that it would affect me, since I'm the one who originally sold you that contract or sold you that promise. Or if the tables were turned and I wanted to exercise an option contract that you sold me, you might think that that's actually going to affect you when I decide to exercise that contract. That's not the case at all. The OCC, created by the exchanges, wants to promote integrity and transparency because they want everybody to feel comfortable, warm and fuzzy, trading and investing. They want lots of volume in the market. So they figured what happens if we jump in between the trade. So as the buyer of an options contract, although I'm buying from you and you're selling to me, once the order is set in place and the trade happens, the OCC jumps in between us. The OCC becomes the buyer to my sale and the seller to your purchase. The OCC, think about it, they're actually buying and selling the same exact security at the same exact price at the same time. So they have no risk, there's no capital string on them, no debit, no credit, the transaction's a wash. But what they've done here is effectively taken the relationship, the contract connection between me and you, out of the picture. In essence, now you're trading with the OCC. You can get in or out of any contract whenever you want without affecting me. So when you think about it, you say, well, what's to stop the person on the other side of the trade from not honoring that contract? And the answer is the OCC. So now I'm separated from you, you're separated from me. I can now do whatever I want with my side of the contract and not affect you at all. You could do anything that you want, which is also a beautiful thing, because now the OCC, through the FDIC, guarantees your side of the trade individually. They guarantee my side of the trade. They guarantee your side of the trade. So since the creation of the OCC in 1973, very shortly after options started trading, there's been not one single contract to ever default on an options exchange, not one. Because the OCC stands in between all trades, and they themselves are insured by the FDIC. They guarantee the performance of all option contracts. And when I say that, I don't mean that they guarantee you a profit. Let's not get crazy here. The OCC isn't that cool. But when I say performance, I mean that they guarantee when an option owner wants to exercise an options contract, that's going to be honored. So the OCC guarantees performance of your option. And now, through the help of the OCC, you don't ever have to worry about what the other side of the contract is doing or not doing. So that way, you're guaranteed that your contract will be fulfilled. And now the OCC, they also do something else. The OCC decided, you know what? Just so there's no confusion, to make this better and easier, to give us a better way of having more liquidity, the OCC is responsible for standardizing the option contracts. Number one, and this is going to be an extremely rare example. You're hardly ever going to see this happen. But in the extremely rare situations of a stock split, special dividends, stock dividends, or a company that has a spin-off of some kind, each contract controls 100 shares of the underlying stock, except for any of those very, very rare situations. Again, an options contract represents 100 shares of stock. It is possible that an option contract represents more or less than 100 shares, or that it represents shares of two separate company stocks, like in a case of a spin-off or something like that, when AT&T was broken up and then the option holders of AT&T got all the baby bells. You'll almost never see the extremely rare occasion when that's the case, but if that ever is the case, you'll be able to spot it right away. And here's why. Let's look at the popular Bank of America. Now, if you look at the July options or the 2010 January options, you're going to notice that there are several series of the same options. The July options have 2 versions, and the January 2010 options have 3 versions of the same series, the same exact option. Now, when we expand the 3 series of, let's just say the January 2010s here, when we expand the series, you're going to notice that even though they have the same strike price, same expiration months, you're going to notice that there are 3 different versions, or that there are 3 different versions of the same exact series, and they each have very different prices. The first, January 2010, is trading at 2 cents. The second one's trading at $2.89, and the third, January 10, is $3.95. They all have the same strike price, $10 per share. They all have the same expiration month, yet they have different prices. Now, the reason for this is the first January 10 right here, that's trading at 2 cents, is the result of a merger with Countrywide Financial, the mortgage company that just got annihilated. So the old Countrywide option holders own options with 0 bid. That means they're not worth anything. They used to own options on Countrywide Financial. It got absolutely slammed. Bank of America picked them up for pennies on the dollar, and these are the guys that used to own the Countrywide Financial options. All trading platforms are different, but if you look here, right up here in red, you're going to see that this one even tells you that there's an 18-share deliverable, not the traditional 100 shares. If you look at the second one, you're going to see that there's an 85-share deliverable. This is a result of the merger with Bank of America and Merrill Lynch. So if you own the Merrill Lynch options and they get bought out by Bank of America, you're going to end up with these options. The third January 10 is the standard option as opposed to the non-standard option. So the third one that you see here delivers 100 shares of Bank of America, as you can see right here. Whenever you see a situation like this, where existing options are adjusted for a merger or anything else, there will always be new standard options created. The first two only exist for those who are in the old options. If you're a new buyer entering a position, there's always going to be standard options available to you. Now, when a special stock dividend or a merger occurs or something like that, they might adjust the option, but you'd see that right away. You'd see that immediately, and then you'd question it. So don't let that remote possibility intimidate you whatsoever. You're going to see it immediately. It's something that you're going to notice right off the bat. First of all, you can see right next to the option in this platform, it says 100 next to one and something else next to the other, representing 100 shares or another amount of shares. The others are different. Most firms note things like that. In other words, most online brokerage firms that you look at are going to note things like that. But again, don't worry about it. You're going to see the difference right away, and just take a look at the difference. Here's ExxonMobil. Here's the way it normally looks. You can see that there's one version of every one of these options. There are no duplicate series. The Bank of America had 3 different series. On ExxonMobil, there's only one, and that's almost always the way it's going to look. If not, you have a question about what's going on, just ask your broker about it. Call him up, call her up. See how smart your broker is. And if your broker disappoints you and sounds like he should be wearing a propeller on his head or perhaps a dunce cap, then you can just go to the OCC website, which is optionsclearing.com, or you can just call them at 888-OPTIONS and ask them about it. Now, usually if there's a stock split, they're going to adjust the strike price of the option. So, for example, from the stock owner's perspective, the way that the stock split works, let's just say there's the most popular 2-for-1 stock split. The option holder that used to own 100 shares with the stock trading at $50 is going to see in his account that he now owns 200 shares with the stock at 25. It's twice as much stock. It's trading at half the price, which is the same $5,000 investment. Now, when that happens, what happens to the options? Well, I told you typically what they try to do is make sure that the strike price changes. If they could just change the strike price, make it easy on everybody, that's what they're going to do. So the option holder is going to look in her account, and she's going to see that while she used to own one option trading at 8 for 800, she's going to own 2 options that trade at 4. Still, in both situations, she has $800 invested in the option. That gives her the right to trade the same dollar amount of stock. So she's also going to notice that the strike price has been halved. You can see this is the January 50 call becomes the January 25 calls. Now she owns 2 January 25 calls. Gives her the right to buy 200 shares at 25 instead of 100 shares at 50. It's the same exact thing. Simple enough, right? Not a big deal whatsoever. I've had stock split in the past, and I've had some investors whose money I was managing call me up or email me freaking out because they see that the options price or the stock price is cut in half. Or even worse, in a 3-for-1 stock split, it's cut down by 1/3 or by 2/3, and there's only 1/3 left. They think that they're having a nightmare. Don't sweat it. Check out the situation before, you're going to see the red flag. Check out the situation before having a panic attack. And like I said, this is extremely rare. I don't want you to worry about it too much at all. So again, options are standardized. So it's really easy. Once you think about it for a little while, it's standardized because almost all option contracts represent 100 shares of the underlying stock or the underlying ETF if you're trading exchange-traded funds. Expiration cycles are standardized. I'll get to that in a second. Expiration day is the 3rd Friday of the month. Now, strike prices, aka exercise prices, are set. Now, I just said a whole bunch of things that are standardized, so let's just go over them one at a time. First, let's talk about the expiration date. Now, options typically expire on the Saturday following the 3rd Friday of the month. Like I said, that's technically the only reason Saturday is actually expiration is that's when all the clerical work and everything gets done by the OCC, or the guys that handle all the assignments or exercised options. You don't even have to really think about Saturday, the Saturday following the 3rd Friday. Don't even think about all that. All right? I just tell you that because some people hear Saturday, they get all mixed up. Now you're not going to get mixed up. The last time to trade an option is the 3rd Friday of the month. the market closes at 4 o'clock Eastern Time. And that's when you're no longer going to be able to trade the option. That's it. Options expire, for all intents and purposes, on the 3rd Friday of the month, just like you see on your screen here. Last time you're going to be able to trade them is 4 o'clock Eastern Time. The last chance you're going to have to make a decision on whether or not you want to exercise your option that you own is at 5:30 Eastern Standard Time. So one thing I want to discuss with you very quickly is short months versus long months. Now, you think all months are 30 days or 31 days, right? Or except for February. Well, let's take a look. The May options, if you buy a May option, let's just say at the last day of April, you might be in for a big surprise. You're going to find this is a very short month. Here's an even shorter month in August. The reason this is a short month is it starts on a Friday. So basically, you have 2 weeks and 1 day until this option actually expires. Here's the opposite. Look at June. This is a long expiration month. You can see you've got about 3 weeks worth of trading. So if you're trading options that are near-term options, you might want to take a quick look at whether you have a short month or a long month. All right, now I'm going to go over some things that you're not really going to have to remember. I don't want you to feel intimidated when you see all of this. Just little-known facts, so you don't think that you're going crazy. Let's talk about expiration cycles. Each month is set under a specific expiration cycle. If you go in and you look at all the different months of all the different options that you can trade, you're going to notice that you don't have the ability to trade whatever month that you want to trade. Now, there are 3 different expiration cycles. At any given time, there will normally be 4 different expiration months trading on a particular stock. All stocks will have options listed for the first 2 upcoming expiration months, along with 2 months from their expiration cycle. So there's 4 expiration months listed at any given time. There's 4 in the cycle, plus or including the current month and the coming month, also known as the front months. You'll always see options available with expiration for the front 2 months. So if it's June 1st, you'll definitely see June options and July options available. If it's late January, early February, you'll definitely see February and March options available, and so on and so on. So again, you'll always see options available with expiration on the front 2 months, and then 2 additional months from one of these cycles. Now, that's standard, and there are other things that we're going to talk about, longer dated options, especially the more heavily traded stocks like Exxon or Microsoft. They're going to trade longer dated options called leaps. They expire 1 or 2 years out, sometimes 2.5 years out, and I'll cover all that in just a minute. But first, here are the 3 expiration cycles that I'm talking about. Every stock, and this is stuff you don't really have to remember, just little known facts, every stock has options expiring on the 2 upcoming months, and then they're on one of these 3 cycles. Again, you don't have to remember or even think about what months are on what cycles. I'm just telling you this so you know that they exist. Here's the ExxonMobil options chain again. Now, you can see that this was taken in June of 2009, and we know that because we can see that's the first option that's available, June 2009. And so they list the first 2 options, June and July of 2009. Then you can see that it's on cycle 1. And you can see that because it includes October, which is on cycle 1. Again, I never even used to know about this until years after I started trading options. I just looked to see which months were offered, that were available, and I traded what was there. So this is of little importance, just so you know, just so you don't think you're going crazy, and just in case you ever wonder, now you know. Now, we also have 2 other option months that are listed that I mentioned before. They're called LEAPs, Long-Term Equity Anticipation Securities. It's a big name. It just means options that expire in more than a year. So don't get confused. LEAPs are options. They're just longer-term options. They're 1 year out, January of the next year and the following year, and the January of the following year after that. So when it's December, the next month, there will be a January option. That's not a LEAPs option. The January that expires 13 months later is. Then there might be yet another option that expires 12 months after that. So don't get confused with the idea of LEAPs versus options. They're the same thing. In fact, the term leaps is just a marketing gimmick, and it was made up by the OCC. They felt it was kind of necessary back in the day when most people were afraid of options. So the options that were longer dated made people feel warm and fuzzy because they had a lot of time before expiration. So they just called those options another name, leaps. The last term that we talked about was strike prices being set. The last set and standardized thing that you're going to find is the strike prices. You don't just have every penny as a strike price. We'll talk about what a strike price actually is, but the fact is strike prices are also standardized by the OCC. Here's the strike prices right here. It's the price at which the deal is going to be struck at. We'll get to that in a minute. First, let me just show you something. Here's an options chain, so basically just a list of the different available options on DGX, Quest Diagnostics. The red boxes are around the strike prices, and you can see that there are 4 strike prices in this case that are shown on this screen. But the point is that strike prices are standardized. There are always at least 3 strike prices for each month.